Good morning, everybody. Welcome back to the Schwab YouTube coaching channel. Our next topic, Trader Talk in today's market. I am your host, Kevin Horner, joining you from beautiful Denver, Colorado. I am running solo today, but I am joined in the chat by my friend and fellow Schwab coach, Brent Moore. So please say hey to Brent. He'll keep an eye on the discussion happening there in the chat. You know, this last few sessions we've hosted for you on Trader Talk have been really lively in the chat, which I absolutely love. I cannot get enough of the community that y'all have here in the chat. So please continue to utilize and rely on the chat. Respond to each other. You know, I'm going to work to bring your comments, your questions into our discussion today in the solo session here, but we got plenty of charts that we are going to look at today. I've got a number of good individual securities from upgrades and downgrades, so plenty to cover with all of you. So we're going to get right to it. But before we do, please remember to follow Brent and me on X, Brent Moores CS, Kevin Horner CS, and don't forget to subscribe to the Schwab YouTube coaching channel. Let's cover our disclosures, everybody, so that we can get to the good stuff for you here this morning. Please remember that our conversation is exclusively for your information and your education. Remember, we do not make recommendations here. Any expression of opinion should be considered subject to change without notice. And of course, we're going to look at a bunch of stock today. None of these are considered to be recommendations in any way, shape, or form. We will talk technical analysis today, of course, as we work through these charts. It's important to remember that technical analysis should be considered merely a piece of the overall decision-making puzzle. We discourage you from relying on technicals to make your decisions exclusively. So think of it as one piece of the overall puzzle. Rely on those decisions, or rely on those multiple pieces to make those decisions, that is, rather than simply one thing, and certainly not exclusively what you get from technical analysis. Now, we will follow our traditional agenda here, everybody. So we'll start with our broad market review, hit up the major indices. Today, we'll definitely hit the S&P 500, the Russell 2000, the NASDAQ 100, and the semiconductor index, of course. Trying to get a nice lay of the land here and understanding of where trend relies. I've got a from there, we're going to move into news, basically. So I do have some individual charts we're going to look at, but also some broader stuff, some market breadth chart that we'll cover as well, that one of the many of you frequent attendees will be a bit familiar with. So, all right, let's jump right to it, everybody. We're going to get into the S&P 500 here. We are flat off the open. But I'll tell you what, everyone, if you're a trend trader, a trend follower, you haven't had a whole lot of reason to do anything other than stay with the trend in the S&P 500. And the trend here, most notable, I would suggest, is that orange 20-day simple moving average. In fact, I'm going to start this out by just highlighting these details. So I'm going to put it in, and today we're at, looks like 61.21 on the 20-day moving average here. So I'm just going to put that in and give you a little color coding to make this a bit easier to follow and track. So, you know, why is it that the 21-day is so important here, everybody? Well, it stems from the fact that we have held it all the way back to April 23. And those of us who've been having this conversation on the constant weekly drumbeat here in Trader Talk, you know we've covered this. We talk about it all the time. We're looking at having maintained the 20-day all the way back since April 23rd. So a quick line draw to help me cheat, because I don't need to count the number of days, but if I can see it here, everybody, we're at day 54 above the 20-day simple moving average. Now, a trader who wants to continue relying on the 20-day has to admit that they've got a bit of risk here, right? Because if you want to be a seller of your S&P 500 positions on weakness, it might mean you need to close below the 20-day moving average to define a broken trend. The unfortunate aspect of that, of course, is that's at 61.21. We're at 62.58. You've got to be willing to give up 138, 140 points to the downside to be proven that the S&P is now out of trend, and that means a significant pullback. So the question becomes, how do you, as a trader, manage those positions for yourself? And so some of those concepts we'll get into here just for a second. Some of you like to sell into the strength of the market. You can utilize the rally we've participated in over the last couple of weeks, which basically took out the short-term highs right here and have now moved aggressively to the upside. And when I say aggressive, I don't mean because the move to the upside is substantial. It's not huge, but it's also not small. We're looking at about a 200-point rally here, 240 to our peak. But if we added another moving average or shifted our time frames a little bit, instead of the 20, 50, and 200-day moving averages that I've got on here, I'm going to change this to a 10, 20, and 50-day simple moving averages, okay? And the reason I'm doing this is because look at how now that we've broken out, we've maintained the 10-day up here. Now, again, trend traders need to define their individual time frame. You need to know your comfort zone for sticking with something like this. Now, if you want to be a seller on weakness, as I said, the 20-day moving average is quite a ways away. But the 10-day today resides just 40 points beneath us. Now, that doesn't imply that a break of the 10-day moving average is going to result in a broken uptrend, but it would be perhaps reason enough for traders to take some profits if you got to close below the 10-day. The implication there could then mean, hey, I'm going to potentially test the 20-day. And some traders wouldn't want to stay with a full position size as you make that type of a pullback. Some of you would say, no problem. I've been in this since all the way back in April, or maybe you were more aggressive and you bought in the most messy portion of the pullback. Then your returns are fantastic up here, and you might be okay giving up some of that pullback to a 20-day level, for example. And again, I want to point out, I'm not suggesting that that's going to happen. I'm trying to simply position so that traders understand some levels where they could start to make changes to the way they're doing things here, right? A lot of you know, sticking with the trend, you haven't had a whole lot of reason to make some shifts in here, but that doesn't mean if you're uncomfortable, you shouldn't be taking some action at these elevated levels. I think we've seen a lot of the risk seemingly leave the market of late. If you were with us yesterday, Brent and I talked quite a bit about the VIX, and the implication it is telling us is the VIX had been sliding lower and lower, indicating a lack of traders and institutional investors notably buying up S&P puts, which tells us that they're very comfortable maintaining S&P longs as we continue forward. That's a pretty decent indication, but it does not tell us that the market only has upside. Of course, we as traders, we must manage our risk individually. Okay, so a lot of traders will tell you yesterday's price action, just a continuation of what's been happening. And you could see, as a brief example, very brief, very quick 2-day pullback to the 10-day moving average, and then we're right back above it. So if you're following trends, everybody, in the most recent period, dating back to mid to late April, April 23rd, most specifically, if you just watch the 10 and or the 20, you can manage your individual positions against those perhaps. Again, define your risk specifically to your comfort zone, your tolerance, and so forth. It's very important that we as traders do that for ourselves. It'll make it a much easier process when it comes time to make those decisions. So a wonderful rally in the SPX here, obviously. And most interesting to a lot of us, I think, is the fact that the NDX has been making essentially the same move to the upside. Captured the 20-day, April 23rd. Everything there remains the same, right? Now, the 10-day, we've had some bouts with the 10-day moving average, right? We've been below it for very limited periods. And when we have closed below the 10-day, interestingly, it's been the 20-day that has provided support. So from the standpoint of traders potentially utilizing the 10 and the 20 together, one consideration that traders will utilize is that when you're above the 10-day, they can stick with, as an example of how they might do this, they might stick with full position as long as the group, or the index in this case, maintains the 10-day moving average. Then a close below the 10-day brings risk that we could see the 20, so therefore they might lighten up a little bit on a close below the 10-day. And that gives them the comfort to allow the pullback to the 20-day. If the 20-day holds, they'll stick with what they've got. And if the trend reasserts, they may even choose to add back those shares. But That is a process that is part of laying a thesis, laying a playbook, and then adhering to that playbook. And then, of course, you know what? Given the strength of the 20-day, the consistency of the 20-day, many traders on a close below the 20-day would take action here because of the time frame we've been above it. Again, 54 consecutive days above the 20-day moving average is nothing to look at and say, well, that doesn't matter. It absolutely matters. And so just as much as 54 days above the 20-day matters, a single close below the 20-day will have implications for the trend as well. Okay, now we're not seeing that right now, and it's very easy to just simply look at the market and say, nothing to see here, nothing to worry about. I'll just go ahead and maintain my longs, and you could possibly be just fine. However, going forward with the belief that there is no risk to the market would probably be a fool's errand. So my encouragement, as often is the case here in Trader Talk, is to remind you to build a thesis of what you think can happen, what you think could possibly happen if things get dicey, if a headline reaches the market, if the administration makes a specific tweet, whatever risk factors you want to incorporate, do so. Build a thesis of best case scenario, worst case scenario, etc., so that you have a plan. You know how you want to act if things change, okay? And my last comment on that is if you're thinking about downside, as we all should be always thinking about downside, right? Always consider your risk. When you start to think, I think that for example, I think the NASDAQ could pull back to the 20-day moving average, and you'd probably feel comfortable with it because of the time frame of maintaining the 20-day, right? But if that were to happen, I want you to say, what happens if I'm wrong? What if the 20-day doesn't hold? What if it's the 50-day? And now I am down suddenly, from where we have been here, we would have to test the 50-day, everybody, we'd fall by 6%. And I'll tell you what, 6% wouldn't be a big pullback, but it would be a felt pullback. I would feel it, you would feel it, the market wouldn't be terribly comfortable because the odds are strong that if we visited the 50-day, it's probably going to be a little bit more of a speedy move. We're probably apt to see that over a couple of sessions, 2, 3, 4 sessions, as opposed to the grind to the upside that we've been witnessing here. So, Barry, let's talk briefly about your question here. Would you use the 20-day as a stop level? Well, first of all, I'm going to mention that from a trend standpoint, a process that a lot of traders might incorporate is to work with those moving averages, the 20-day on the SPX, the 20-day on the NDX. And yes, they might set stop orders beneath, but again, the concern is that if you utilize a stop order, for example, as a good till canceled order, and you're just letting it go, you got to build in some wiggle room there, right? So the question is, how do we define wiggle room? Well, for a lot of traders, it's not utilizing the 20-day moving average and placing your stop right at it, right? Because you don't want to be stopped out at support. You want to be stopped out when support breaks. So that means that a lot of traders just simply are waiting for closing values, and they will allow the market to close and then start formulating their decisions. That's one way of thinking about it. Now, not everyone is going to be comfortable waiting for the closes. So let's give you one other step for consideration. I'm going to bring in my tools here, and I'm going to add the average true range. And on something like an index like this, you have to admit there's going to be big levels, big moves, right? Well, here on the NASDAQ, and this is, by the way, a wonderful indication of the grind to the upside I've been talking about. Look at how the volatility here in the NDX, we were getting 800-point swings, low to high intraday back in April when things were really messy, right? Since then, all we've done is grind to the upside in price, and look at how the average range per day has shrunk from 800 points a day all the way down now to 248 a day. Now, how is this incorporated into the potential usage of a stop order? Well, some traders might look at that current 20-day moving average at 22,271, and from there, might then reduce by the amount of the ATR. So 22,271 less the 248 average points we have daily right now could put us down at 22,023. Now, that's a pretty significant level, right? Let's go ahead and find 22,000 essentially is right about here, I think. Pretty close to here. Yeah. So, this was the gap level, everybody. So not only are we able to, with a little bit of math, incorporate the 20-day moving average, but we have now found that if we incorporate one ATR, that we could possibly be into this gap zone from where we basically broke to the upside. This is a really interesting level that some traders might consider, because if you intraday traded through the 20-day moving average down by that 250 some odd points, yeah, that's going to be a significant move, about a 1% violation of the 20-day moving average. And that might be a calculation that some traders would use as a means of getting stopped out, meaning instead of using a stop nice and close to the 20-day, they would really want to give it the opportunity to maintain, because as you can see back here, for example, we traded below the 20-day intraday before the market got bullish again, before traders stepped in and supported the NDX at that 21,520 level approximately. So it's not been uncommon to have that occur in this recent trend. So you don't want to get stopped out at support. We want to get stopped out when support breaks. Now, I need to remind you, of course, in any of these circumstances, remember that stop orders, if you choose to utilize this traditional stop, which triggers and becomes a market order, it guarantees no price at all. You always have the gap risk associated with your stop order. Remember, your stop level is simply a trigger. And if we're above that stop level on the close today, for example, but then tomorrow we opened 200 points below it, well, your trigger is going to happen at the open trade, and your execution is likely to be that approximate 200 points lower than it would be based on your trigger price, right? So you have to know that. The stop order is designed to help you mitigate risk, but it is not a perfect order. Now, of course, you can incorporate the stop limit where you set the trigger and a limit price thereafter, but then your risk is that the price, you can't get the limit price you want, and now you have risk to the downside anyway, right? So there's not a perfect approach there. If you're not familiar with stops, everybody, or haven't utilized them previously, I would simply encourage you to give our trading desk a call and just talk it through with a broker so that you can have the full understanding of the mechanics of those stop orders, especially if you've not used them previously. All right, so there's a brief synopsis on the NDX. I hope that was helpful for you here, Barry, in use of looking at the 20-day moving average for a stop and the potential to utilize that, but also doing a little bit of math around the 20-day to help you maybe pick and set a level there a little more appropriately. All right, let's check out what's going on in the small caps. The Russell. We have been kind of pleased with the Russell of late, everybody. Yes, it's been moving to the upside. Those of you, again, who've been here quite a while, you know the importance of that 2100 level, everybody. This was such an important level for us to get back above. It was, and maybe the neckline, the green line here, the neckline of a inverted head and shoulders, and having cleared it, not only did we clear it right here, but we came back and tested it at the same 20-day moving average, everybody. So a really appropriate new trend in place. The Russell off of the lows here doing quite well. We're up at this level about 30% off of those April 7 lows. So really quite a nice move, but let's not get too head over skis. Let's make sure that we're monitoring the majority of the trend here. Again, a lot of traders are going to keep an eye on that 20-day. We do have a wonderful upslope to it. And I think if I went back and changed my studies to my standards once more for you, the 20, the 50, the 200, a lot of traders are going to be encouraged by this development right here. And that is the orange 20-day moving average upsloping and crossing potentially the 200 to the upside. And that looks like it's going to happen over the coming couple of days here. Assuming, and actually even if we came all the way back here, chances are you're still going to see the 20-day cross the 200 because the upslope to this move has been so substantial. So we're about to get that shorter term cross of the moving average and strengthening that confluence of data here at about 2180 or so. So there's a lot of traders out there, everybody, watching that 2180 level. And when you get confluence of moving averages like this, it can be really instructive for the trader. Now, let me explain briefly why that is. This is, as we noted, the 20-day moving average. That's a short-term trend viewpoint, right? Many traders leaning into the 20-day aren't as concerned typically with the 200-day. They're very disparate moving averages. 200 days versus 20, you're looking at 1 month versus 10. That's a big difference. And while the investor utilizing or the trader utilizing the 200-day is going to be thinking about things a little more long run, the real takeaway is the two very different types of traders, everybody. Two different time frames, both paying very close attention to the 2180 level. And that tells us that support is there and for two different types of traders over two very, very wide time frames. And a pullback to this level wouldn't be unexpected, but bounce at that level would have to happen, right? A move backward through 2180 in theory could be supported by the 50-day at some point again. And ultimately, really, based on what this pattern looks like and the way that it has developed, I think a lot of traders would suggest you'd be more comfortable, of course, holding 2180, but even a throwback to the 50-day would be okay for the trend. So it wouldn't feel great because we know we'd be about 150 points down from such a move, right? That wouldn't feel fantastic in the current scenario, but you would still be witnessing an uptrend because even a pullback to the 50-day, if it stopped there, that would still be a higher low. This being the last real true low we've seen here. So if it stopped at the 50-day, it would be higher than this one, which was higher than this one, which was higher than this low, higher than this low, and so on and so forth. So we can clearly see a short-term trend here in the Russell that's been working out quite well. Okay, and then the last one, everybody, let's check on our semiconductors. They have broken through a major zone of resistance. Many of you, again, we were watching this 54.45, 54.50 level on the Philly semis here. We broke through that line for a long, long time. For many of you longtime viewers, that line was red until 2 weeks ago when we took it out, and now it's green. And look, and we just got done talking about confluence, right? The use of trending moving average, like the 20-day, getting caught up to an area of potential support horizontally. Well, that's exactly what we're witnessing right now, isn't it? We are seeing the 20-day right into that 54.45 level, strengthening that level from a support standpoint. Again, if we're building a thesis on the semiconductors, we'd love to see the 20-day just keep doing what it's doing. We would be very cool with a consolidation of time, just sideways moving as opposed to quick retreats to test the 20-day. But it's a possibility, any kind of weakness the market brings, a headline could throw semiconductors back to 54.45. If you're a trader, you've seen this happen, right? You break resistance, you trend upward for maybe 2 weeks, 3 weeks, and then you come back and test the level from which you broke, test, hold, and then the trend reasserts itself, and then you're right back in play for the trend that's been working all the while. Now, again, I don't know what's coming here. No idea, but I can say that I have some ideas, as many traders will, about how to manage things along the way. And I will set some ideas of this is how I'm going to approach the market. If this happens, if the upside continues, here's what I'm going to do. And if the downside happens, or if some breakdown in the trend changes, then here is what I'm going to do. I've already given myself those steps so that in the moment, I don't have to think about it. I can just reference my notes and go, oh, all right, I said if this was, for example only, not me, right? But some traders, if you traded below the 20-day on a closing basis here, they'd probably lighten up some of their semiconductor exposure. especially if they didn't sell any at the top up here, right? If this trade today is the highest trade we're going to get in the semis for maybe the next 2, 3, 4 weeks, and you don't sell up here, well, you got to be able to stick with it to the 20-day moving average in many cases, right? Because that becomes a pretty appropriate level for a support test here. So, again, from what we're getting in terms of tertiary details, the relative strength indicator down below, into overbought conditions, remind you all, overbought conditions are not bearish by nature. Further, overbought does not imply that a reversal has to occur. We can move out of overbought as we did just in here, just for a 2-day window or a 1-day pullback, we were below the 70 line. But that really wasn't an excellent sell signal for you, was it? Because we've maintained price all the while. So as I often say, try not to get too bogged down by some of those tertiary or external factors, things you're looking at like the RSI or your MACDs. You can keep it pretty simple. Certainly in the last 54 sessions, you've been able to keep it pretty darn simple. Sticking with a 20-day moving average has proven to be successful along the way to this point. But again, we don't know if that's going to continue, and if it is, we don't know how long that's going to continue. So find a plan that makes sense for you, build a thesis, pro and con, and then know the steps you want to take when one of those scenarios starts to play out. Okay, everybody, I wanted to bring in another chart here real briefly that's going to speak to a little bit of the health of the overall market. My friend Rachel, who some of you are familiar with because she joins me frequently on Mondays, I get her about once or twice a month, she shared this S&P 500 look that will help us understand the overall breadth of the market at this point in time. And what's interesting here, note the stocks in the S&P 500 over their 20-day moving average. So we're at 60% now. We were there in early January, so we're almost back to where we were starting the year, so that seems notable. We're also seeing very many stocks in the S&P 500 over their 50-day here, 71% up there. And so you can see we're not making highs in these, but we're approaching highs in these. Now, in the last couple of weeks, we've seen that the NYSE annual highs or 52-week highs have come down a little bit as we've gone sideways a little bit, but not negative. What I do take away from here, look at down below though, everybody, new yearly lows. Boy, we just continue to dance along that 15% level, extremely low number of NYSE stocks and new 52-week lows. So this tells us that the market is reflecting a bit of a bullish viewpoint that's been consistent for some times, right? For some time, that is, dating back at least to that early April window or mid-April window. So yeah, this is a chart I can share with you, Ara. I'll go ahead and put this in here. Let me just share right here, but I do need to remind you, of course, any grids we share, any scripts we share, these are not guaranteed for timing nor accuracy, and they are not a recommendation for your use. So let me get that in the chat here for you, everybody. So as a reminder, if you're not already a familiar user of Thinkorswim, the process here is to utilize the setup gear in your upper right corner, open shared item, and just paste that link right into here, hit preview like so, and then you see what you've got to work with. You can give it, go ahead and hit import, and then it'll launch right for you, okay? So just another step there so you all know how to do it. Do not click the link. The link won't work by clicking it. You want to copy the link and paste the link in here. Okay, quick review of what I got going on in the sector action. We're not having a huge move at this point of the day, but we did see here we've got some leadership from industrials. Industrials have been a wonderful outperformer from a sector standpoint this year. You've got a group that makes it, that's a new 52-week high. Let me see this on the weekly chart here. Yeah, goodness gracious, what a move here, everybody. We gapped to the upside here on the week of May 12, And that was when the whole market gapped, by the way. And look at how that happened to go. Not just a gap, but a complete gap and go scenario. My goodness. An awesome move to the upside. We haven't come close to giving back here on the industrials. So that was a pretty strong move. And that level has been maintained. And then you can see here the 20-day, nice upward slope to it as well. But we have had a couple of bouts beneath it. But nothing, when you look at a true breakdown, some traders look for maybe 2 days, 3 days, 4 days below moving averages to validate a breakdown. Doesn't look like we've had that even in industrials. We only had about a 2 or 3 day move consecutively below the 20-day before the big candle got you right back up above it. So some interesting stuff here developing on industrials. We've also had fantastic leadership, of course, from technology. The tech space has also been working really well against that 20-day moving average. I'll bet you're all surprised to find that it recaptured its 20-day on the same day that the S&P, that the NASDAQ did, that the semiconductors did, all back on April 23rd. So some interesting developments from a sector basis, but I'll remind you all, you break out like something like this, everybody, and you start to see trending thereafter. That's the type of maneuver bulls want to see. Horizontal resistance can then become horizontal support. The likelihood is here that a lot of traders are watching that 20-day, but again, throw a 10-day on there and you're apt to see that for the last 2 weeks you've been holding it. And my goodness, it's even been longer than that. Look at the 10-day here, everybody. We've been below the 10. Okay, so let's go back just to the last time we tested and maintained it right here. So that was May 30. And if you've been a buyer since we've basically held and maintained the 10-day here, you've done really well in IT also. So again, define the moving average you want to work with. Some traders don't have a preferred moving average. They let the specific either sector they're watching, index they're watching, stock they're watching, they allow that to define it perhaps. That's a possibility. But whatever the case, set a plan, have a plan, stick to your plan, trade your plan. Okay. All right. We've definitely got some stocks in the news this morning. Let's check them out. First of all, I'm going to throw my standard moving averages back up. I mentioned a bunch of stocks in the news this morning. One of them, let's see, we're going to lead with Oracle today. So Oracle was upgraded at Piper Sandler today. Oh, and I've got a whole bunch of drawing tools on the chart already. So let's see what's going on. So we had a downtrend breakout right here in late May, and we've allowed the 20-day moving average to get caught up, and things have been going gangbusters here. Depending on how you look at this, there's a number of ways for traders perhaps to consider what's been going on with Oracle. First of all, let me give you the rundown of the news here. So Piper Sandler upgrades Oracle to overweight from neutral, new target at 270. That's up from 190, excuse me. That is an 80-point leap. Nothing terrible there. The firm's latest Chief Investment Officer survey reinforced a bullish spending backdrop for artificial intelligence infrastructure. So for Oracle, increasing enterprise demand could add another layer of growth to the company's OpenAI Stargate opportunity, according to the analyst here. So essentially, they think that there's more upside here, obviously, but I'll remind you, price targets are never guarantees, whether it's a price target from the analyst at Piper Sandler or if it's a measured move price target like I've applied here. Let me talk about that real briefly, everybody. So this white line, this vertical white line, all I did here was duplicate this line, which is the flagpole. So if I zoom in to what's gone on, let's try this. There we go. Okay, so this was our earnings right here on June 11, and then June 12, we had a gap move. So some traders would look at what happened here. They would take the height of the flagpole, which was basically a 2-day move to the upside, where we ran into short-term resistance around 215, 216. This pole can then be part of a measured move calculation. So let me duplicate that line, and I'm going to add it. Now, there's a couple of ways to do this. A lot of traders will start from the breakout and draw it like so. and suggest that the upside then is in the vicinity here. So in this case, it's like 250 to 257. We could call it like that, right? Some other traders would say, you know what, I'm going to try not to get too aggressive. Sorry about that, everybody. There we go. I'm going to start my line instead of at the breakout. I'm going to start it from maybe the trend line, the uptrend line. Okay. I'm not going to give you a specific. I don't know which is going to be the best. And I certainly don't know if any of these measured move targets are going to be achieved. But I wanted to just highlight a way that some traders would look at this, right? This is a very interesting development. I think we should also move off of the daily to ensure that we've got an understanding of how maybe the intra-period chart looks. For a lot of traders, this last week is kind of messy in here, isn't it? There's an up day, a bit of a down day. We had a fake out breakout opportunity, right? We had an intraday move to 241.44, and then we were right back down. In fact, we were down, I had a 10-point swing that day almost. So it's been kind of messy. But if we move into something like a 4-hour chart, I find this to be a little bit interesting here, everybody. All my lines are the same, but you can incorporate some other moving averages, some shorter term stuff if you'd like, and try and find some alternate trends. And in looking at this one, look at this pink moving average. Let me see here. I think that one is my 52 period moving average. Okay, so let me explain that for you. Actually, let me change that for you, because there's one way to think about this, everyone. If we utilize a 4-hour block of time, well, you might want to change your moving averages so that they coincide with what's happening on a daily chart. So as an example, if we changed my moving averages to a 16 period and a 32 period, these are akin to a 10 and 20 day simple moving average. Now they are these are simple as well. It doesn't mean that they have to be held, but if you're looking for a way to potentially manage a short-term move against what's happening on the daily chart, which might be a little more difficult to view and see the actual trend, well, since we broke to the upside, it doesn't look nearly as messy here in the 4-hour chart, does it, everybody? It looks a little bit more consistent. And if you can find consistency like that, whether it be on a 4-hour chart, a 1-hour chart, 4 hours candles, excuse me, as I'm using here, 1-hour candles, whatever the case, if you can find some semblance of consistency in a shorter term window of time, it can be really instructive. So just as an example here, one way that some traders might look at this is to monitor that 32 period moving average and see if we trade below it and trade below the lowest low in this period as well, which would be right here. Some traders would then say, aha, now we've got a bit of a short-term pullback potential, and they might then start maybe selling a little on weakness, not selling all, but maybe selling pieces. Because again, the trend has very clearly been up aggressively. You've got positive narrative behind it. We know it doesn't mean it has to go higher, but if you want to stay with the trend, this is one way that some traders might give consideration to it, right? Shorten your moving averages, work with a shorter window of time, and see if you can find a shorter term trend that's a bit more visible than, say, what you get on the daily, okay? All right, so there's one. Let's also talk about, I see some of you asking about CoreWeave. I do have a story on CoreWeave. So let's talk about CoreWeave briefly. CoreWeave was downgraded today at Needham, likely part of why we're seeing a nice little pullback here, almost 5%, about $7. But everybody, before I get to the note on it, what's going on with that 20-day moving average? Forget the downgrade out of Needham here for a second. Have traders been given some reasons in the last week to get a little more defensive on CoreWeave? Many traders would say yes. You've got Let's see, we closed below it here day 1. Day 2, we were below it. Day 3, hey, we popped right back above it. Nothing to see here, right, bulls? Except the very next day, we were right back below it, or we got a doji right on the 20-day. Now, today, we are 3, maybe 4 days below the 20-day in consecutive. Now, we have not made that lower low, so some traders are still speaking to themselves, right? They're having a conversation. Their internal monologue might be, hey, we haven't made that lower low yet. I don't have to be concerned. Some traders are going to stick with it, perhaps, as long as you don't take out 142, right? 142 to the downside could bring the 50-day moving average, or maybe a bit more of a horizontal support coincident with what were all-time highs at the time, could be right in the neighborhood of 124 as well. Okay, so let me set some levels there, and then I'm going to speak to you about the actual story from Needham. I'll give you some quotes. So there's 142, and here about, let's call it 125. And again, you might be comfortable writing from 142 down to 125. You know, that's 17 points, though I would suggest not all traders are going to be comfy with that, but some of them will, right? So do the math. If you're comfortable and you're saying, hey, I think the 50-day is going to hold up, hey, great. And if you can manage all the way down to the 50-day, staying with the position you're holding, and then if the 50-day breaks, you sell, and you're cool with it, right? Giving up 17, 20 points or more and then selling, terrific. Nothing matters more than your individual comfort for the trade, okay? Know your true risk. So, as Wiley is pointing out, he's mentioning the so-called Horner Rule. Listen, all the Horner Rule states is I want you to have a definition of confirmation for you, whatever that is. For some traders, it's that first close below the moving average that was support along the way. They're going to start selling. For other traders, it's 2 days in a row below it. Some of them 3 days in a row below it. Have a definition of confirmation, whatever that is for you. In this case, confirmation of a broken short-term trend. Does it mean it can't go up from here? Absolutely not. But it might mean a broken trend needs more time to then play out and before it once again reasserts itself to the upside. Okay? And the ultimate question is, can you manage all of that window of time, right, in between it finding support and eventually bouncing if it's going to play that way? We don't know. Okay, so the story on this, Needham downgrades CoreWeave to hold. They had been at buy. They didn't give a price target. Okay, traders always love price targets. We don't have one here. Now, the firm, Needham that is, believes that the company's acquisition of Core Scientific this week, which we heard about, is a strategic fit, and it can unlock an estimated 150 to 200 MWs of additional capacity for AI workloads. However, Core Scientific's valuation is full at its current share levels, according to the analyst in Needham's research notes. So, a little bit of high valuation on Core Scientific specifically, and I think that's what's led to the downgrade, according to Needham here today. Again, that doesn't mean the trade's broken. It might just mean needs a little time before finding its next foothold. Hopefully for bulls, that's at 142 as opposed to 125. We'll see how that plays out here. Last one I'm going to give you, everybody. We did have another upgrade. This one a quick one, so we'll briefly look, and I'm almost at time anyway, but AMD got upgraded today. Lots of drawing on my AMD chart here. AMD was upgraded a HSBC to buy from hold. New target on AMD at 200 per share. Why is that notable? Well, we're only at 143, so it'd be about a 35+% premium to the current values. Of course, once more, no price target, no measured move is a guarantee to be achieved, as you know. But taking a look at this pattern here, I think what's interesting for a lot of traders is the action you're getting today, and maybe the action you got just yesterday. If you drew the trend line from the peak down, like so, some traders like to buy the moment you break the downtrend line of a bull flag situation. Yesterday could have been that day. Today you got to follow through. Some of you are going to say, yeah, Kev, that's all well and good, but until I get a close over 146, 146 and a half, I don't have comfort. And I would say, great, you have a plan. That's great. As long as that's your plan, stay true to your plan, right? Always a good way to go about it is to build a plan and then trade that plan. All right. Whether you choose to put that on physical paper, digital paper, or maybe you maintain it up here, having that plan is the most important aspect. Second and most important becomes adherence to said plan. All right. So we are at time, everybody. I want to thank you, though, for being here today. We have had a bunch of new attendees, and I got to say, I absolutely could not be happier. So big thanks to Brent here in the chat. Brent, I really appreciate you replying to so many of these comments. I know we covered quite a bit, but I want to remind you, we are here for Trader Talk 4 days weekly, Monday, Wednesday, Thursday, Friday. Tomorrow's Trader Talk with my man James Boyd will be an ETF exclusive discussion. We do not archive those, everybody. So if you're interested in watching the same similar session here today, tomorrow morning at Market Open with our friend James Boyd, be here at Market Open, and he will lead with ETFs in lieu of indices. So good conversation, but archived, not available. So if you want that one, got to be here live. So thank you all for joining us today. Please subscribe to the Schwab YouTube coaching channel. Follow Brent and me on X. And if you liked today's discussion, hit that thumbs up button for me down below. We're going to get this into the archives as soon as we can for you, and that'll help us in the YouTube algorithm. So I appreciate it, everybody. Have a fantastic Thursday. I look forward to seeing you all again real soon.